Hello everybody. So as promised, I am back with yet another investment strategy in our series of Be Your Own Fund Manager. Well, today we are not going to discuss about any strategy simply because it does not have a name, but we are going to discuss about an ace fund manager and his investment strategy who is commonly known as the legend in the global fund management ecosystem. We are going to understand his stock picking strategies. We are going to understand the journey of a Caddie to a fund manager. So now if you have not guessed it, please watch the video till the end. Welcome back to yet another episode of Market Minds. My name is Sumit Chanda and today we are going to discuss about the legendary fund manager Mr. Peter Lynch. Now, Mr. Lynch was actively managing fund during late 70s to 90s, and why he is known as the legend is because during this period of 13 years, he has generated a CAGR return of 29.2%, which is the world record even till date in the fund management industry. Now, let's go back a little into history and try to understand about his background. So back in the mid 60s, he was working as a caddy in a golf course, and as we all know that golf is a rich man's sport, so obviously elite people come there, and what do the elite people do when they meet? They discuss business, they discuss markets, and that is when young Lynch got his attention towards the markets. He kept on listening to the conversations, he kept on researching on equities, he had also invested small amount in couple of stocks. Later, it interested him so much that he actually completed his education and went on to do an internship with Fidelity. Now with Fidelity, he eventually started managing actively certain sectors like metals, chemicals, mining, textiles, etc. eventually to become the director of their research wing. Later on, he was promoted as the head of Fidelity's Magellan Fund, and this is where the magic happened. In a mere span of 13 years, which was between 1977 to 1990, where he started this fund with merely $18 million, which ended up to become $14 billion in these 13 years, which was nothing but a whooping 29.2% CAGR returns. If I have to compare it in INR terms, if you had invested 1 lakh rupee, in 13 years of time, it would have become 28 lakhs rupees. Don't you think so? It's a magic. And the important part here is to note that there was no bull run during this period. The markets were pretty much flat, and he was still able to identify certain stocks which eventually become a multi-bagger in these 13 years. Now, what was the investment strategy that he was using? What was the investment philosophy using which he was able to fairly identify stocks which were becoming multi-baggers over a period of time? Now, he was simply taking care of three basic principles that even we know in our day-to-day life. One, invest in only those companies which you understand, which you know. Giving an example here, let's talk about MRF. Now, I'm sure that at least 60 to 70% of people investing in the Indian markets would know what an MRF does. What are its products? Who are the customers and where it's used daily? Second would be look at companies which have a competitive edge. Again, giving an example, let's talk about escorts. Now, I'm not saying that escort does not have a competition, but I'm simply saying that it enjoys a lot of competitive edge over others, its peers. Third would be look at certain companies whose products you are practically using in your day-to-day life. Again, giving a classic example of Hero MotoCorp. Now, you talk to anybody in a metro city or a tier 1 or a tier 2 or even a village, he would know that what a Hero MotoCorp manufactures, what are its products. In all probabilities, somebody around would be using that product. So always get into a company what you know. about their business, about their product, about their sales, about their market reputation. He eventually created a proprietary model called GARP, which is growth at reasonable prices, which was nothing but a hybrid model of selecting stocks using growth and value strategy. Now, even now, there are many funds across the globe who are using this strategy to identify stocks. Now, let us look at what this strategy actually is. So again, there are three main points to look into this. Point one is look at the percentage of sales. So if you like a product of any company, look at what percentage it contributes to its overall bottom line, or overall revenue of the company, or the overall business of the company. If the product is good, if people are ready to pay, obviously it has to become a substantial part of their revenue. The second and the most important portion of his strategy is the PEG ratio. Now, what is the PEG ratio? Now, we all are habituated with the concept of PE ratio, which is price to earning ratio. Now, there are multiple scenarios that we can get out of a PE ratio. Scenario 1 can be when the PE ratio is pretty high and the company is also performing. So in that scenario, we need other factors to justify the growth. Now in second case, where the PE ratio is less but the company is still performing. Now that's a very good scenario. It's a good company to invest into. And third point is where the PE ratio is also low and the company is also not performing. Now that's not a very comfortable situation. Still, it's a little confusing here. Now moving on to the second portion of the PEG ratio, which is the revenue growth or the earnings growth. Now again, within this concept, you will understand that when does a company get into a growth phase or a product get into a growth phase? When the entire product, the market, the management, the sales, everything is in proper sync. That's when the actual growth begins. And I'm talking about a year-on-year growth. Now again, if you dissect growth, there can be two portions. One is growth in revenue and second, growth in earnings per share. So whenever you see a scenario wherein the revenue growth is higher than the earnings per share, we say that the company is undervalued and it's a good buy. On the flip side, when we say that the revenue growth is lower than the percentage growth of EPS, we say that the company is overvalued. But it's hell lot of a confusion between the PE ratio and the growth. So that's the reason we look at PEG ratio, which is nothing but PE by growth, wherein we look at per unit returns on the growth. And that actually is, I would say, the main ingredient of the magic formula of Mr. Peter Lynch. Followed by the third point, which is look at companies having strong cash flows, but not so good debt to equity ratio. So look at companies with very good, I would say, cash conversion cycles, available cash, but not best of the debt to equity ratios. At the same time, not worst of the debt to equity ratios. So these are the companies which you can buy at the sweet spot, which will eventually become a multi-bagger as we go ahead. Now that you know the main ingredients of the Peter Lynch formula, which is nothing but looking at the percentage growth in the sales of your favorite product, looking at the magic sweet spot of the PEG ratio, and looking at the cash flow statements and the balance sheet of a company, you can very well go back, do your own research and try to create a portfolio. Now before that, there are certain things that you should keep in mind before investing into a company where you have identified using this formula. Now this strategy would work only over a longer period of time. If you are a positional trader, this might not work. So if you want to hold your portfolio over a longer period of time, like 8 years, 10 years, yes, then this can be a strategy for you. Second, as I said, it's just would identify the growth oriented companies. If your investment style is different, and if you're not preferring the growth or the value oriented companies, this might not suit you. So it would only identify and select the growth or the value oriented stocks. Third would be, this strategy would completely devoid the logic of timing the market. So don't wait for any corrections. Whichever time you identify a particular stock within these criteria is a good time to invest. Don't wait for the right time to Invest, don't wait for the stock price to come down and then you buy. Now concentrate on company stories. Always, look out for certain things out in the market related to these companies. Any news story, any new news can be a successful item for you within your portfolio. And lastly, before investing in any of the stocks identified using this strategy, always try and build a paper portfolio. Make a dummy portfolio using the stocks that you identified. Track it for a good 4-5 months, 6 months, 7 months. Any which ways, it's a long-term portfolio. So a 5 months or a 6 months will not make any big damage to your portfolio. Now lastly, if I have to talk about certain stocks currently which are falling into this bracket, some of the prominent names would be Sun Pharmaceuticals, Ambuja Cements, similarly ACC, then Z Entertainment, as I said, Escorts, and maybe Prince Pipes. But then having said that, please go and do your research. The names of these stocks are simply from the point of view of you doing a research on these stocks and not from an advisory purpose. So please go back, do your complete research before investing into any of these stocks. I hope this session was helpful to you. You could learn few things about the Peter Lynch strategy. We will be coming back with the next episode with another investment strategy. Thank you for watching. Please like and comment. Thank you so much.